Welcome back to Investing Talk Podcast.
Today, we are looking at a company that feels like it's defying gravity. We're talking about Immunitybio.
Immunitybio, right.
And if you haven't been watching the biotech sector lately, you might have missed this one, but the numbers are, well, they're demanding attention. We are looking at a company that has posted over 1,000% revenue growth in the trailing 12 months.
Hold on. 1,000%. In this economy, usually when I see a number like that, it's a typo or, it's some crypto coin that just launched.
1,026% to be exact, and it is not a typo. But the hook here isn't just the math, it's the mission. They're pioneering chemotherapy-free cancer immunotherapy.
Okay.
Their flagship drug, ANKTIVA, is hitting the market, and it's causing an absolute explosion in their financials.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us get this data out to more people.
So here's the so what for today. We have a stock that's up, 230% in the past year. The revenue is skyrocketing. I mean, literally vertical.
Right. There's always a but.
There's always a but. We also have massive cash burn and a valuation that might be getting a little ahead of itself. The core tension we need to resolve here is pretty simple. Is this a sustainable breakout driven by a revolutionary drug, or is this, a hype valuation pulling away from reality?
Okay, let's unpack this, because when you throw around numbers like 1,000% growth, my skeptical arm starts ringing immediately. Usually that's because a company went from making $10 to $100, law of small numbers.
Right.
So let's pivot straight into the fundamentals and see if the math actually holds up.
It holds up. The growth is coming from a very real, very commercial place. This isn't just, accounting tricks or a one-time patent sale. If we look at the preliminary revenue for Q4 2025, they brought in $38.3 million.
Okay, playing devil's advocate here, $38 million. In the grand scheme of big pharma, where you're talking billions in sales for a Merck or a Pfizer, that's not exactly huge. So why is the market freaking out over $38 million?
Context. Context is everything here. You have to look at the rate of change. That $38 million is up 20% just from the previous quarter.
Okay, that's fast.
That's rapid sequential growth. But then you look year over year, it's up 431%. And if you zoom out to the full trailing 12 months, revenue hit $82.56 million. That is where we get that 1,026% figure.
Wow.
They've effectively graduated from development stage to commercial stage in like the blink of an eye.
And this is all ANKTIVA, all from that one drug.
Predominantly, yes. It's the acceleration of ANKTIVA adoption. We're seeing unit growth surging, and that's contributing to a 700% year-over-year sales increase just from that product. This is the moment biotech investors wait for, when the science leaves the lab and actually starts generating invoices. Doctors are prescribing it. Patients are taking it.
Right.
This isn't theoretical revenue anymore.
Okay. All right. I see the top line growth. I can't argue with 400% year-over-year.
Yeah.
That is impressive traction. But let's look at how much of that money they actually keep.
Yes.
This is where it gets really interesting for me, and maybe a little concerning. You have gross margins sitting at 99.6%. That sounds, it sounds almost fake. How?
It does sound fake, but it's real. The sector median is roughly 44%.
Right.
Immunitybio is operating at nearly pure efficiency on the production side. It costs them pennies to make the dollar, essentially. When you have a proprietary biological drug, once the manufacturing facility is up and running, the marginal cost of that next dose is just incredibly low compared to the price.
Sure. Production is efficient. That's great.
Yeah.
But we have to talk about the other side of the ledger. Look at the operating margins. We are staring at negative 347%.
That is
significant.
Significant. It's a bonfire. Their net income is negative $348 million. EPS is negative 42 cents. They are burning cash at a ferocious rate to get that growth.
Yeah.
For every dollar they bring in, they're spending $3 or $4 just to keep the machine running.
That's a fair critique, and if this were, say, a grocery store or a car manufacturer, I'd tell you to run for the hills. But we have to look at why they're burning it.
Okay.
This is classic biotech scaling. They are pouring money into R&D and commercialization. Launching a drug globally is expensive. Sales teams, marketing, more trials. So the question isn't, are they losing money? It's, can they afford to lose money long enough to become profitable?
And you think they can?
Well, if you look at the balance sheet, I think the answer is yes.
Walk me through the liquidity then, because if I'm an investor, I'm worried about them running out of cash and diluting my shares. How long is their runway?
It looks surprisingly solid.
Yeah.
They have a quick ratio of 5.1 and a current ratio of 5.8. Let's just pause there. A quick ratio of 5. For anyone who's not an accountant, what does that really tell us?
Right. Think of it as a stress test. The quick ratio measures your ability to pay off your immediate bills with your most liquid assets, cash, basically. A ratio of 1 means you have just enough to pay your current debts.
Okay.
Immunitybio has a ratio of 5.1. So for every dollar of short-term debt they owe, they have over $5 in liquid assets ready to go.
Okay, that is a massive buffer. That's actually much healthier than I expected given that burn rate.
Exactly. It creates a shield. And look at their leverage. Their debt-to-equity ratio is negative 156%. This is a conservatively managed structure. They are not drowning in bank loans.
So they aren't desperate.
They are not desperate. They have the liquidity to survive this cash burn without needing to immediately dilute shareholders just to keep the lights on.
So they have the piggy bank to weather the storm.
Right.
Okay, but let's talk about the castle they're building. What is the competitive moat here?
Right.
Because a high margin doesn't matter if a competitor releases a better drug next week. Biotech is ruthless.
It is. We've scored them with a narrow moat, about a 47 out of 100, so it's not an impenetrable fortress yet. Big pharma is always a threat,
Right.
but it's getting there.
And the key assets.
It's the ANKTIVA platform, again, and I can't stress this enough, chemotherapy-free, and they're off-the-shelf CAR-NK therapies.
Off the shelf is the key phrase there. I want to drill down on that.
Yeah.
Because usually when we talk about these advanced immunotherapies like CAR and T, they're autologous, right? Meaning they have to take the patient's own blood, engineer it in a lab, and then put it back in. It's expensive, it's slow, it's a logistical nightmare.
Precisely. It's bespoke manufacturing for every single person. It just doesn't scale well. By making their therapy off the shelf, or allogeneic Immunitybio is trying to do for cancer treatment, what, Ford did for the automobile.
Right.
You don't build the car when the customer walks in, you have it ready to go. This creates high switching costs and IP barriers. If hospitals can grab a vial off the shelf versus waiting 3 weeks for a custom lab job, which one are they going to choose?
The one that's ready now, especially when you're dealing with aggressive cancer. Speed is life.
Right. Plus, we are seeing global traction. They just got Saudi FDA approval for non-small cell lung cancer. And the QUILT-106 trial is showing incredible durability in Waldenstrom lymphoma.
So they are carving out a specific niche.
They're protecting their market share in the non-Hodgkin lymphoma market, specifically against those traditional chemo-reliant rivals. If you are a patient and you have a choice between chemo, which we know just destroys your bottle, or a chemo-free immunotherapy that works, that's a powerful moat. That's a moat built on patient preference.
Fair point. If the science holds up, the moat widens. Let's pivot to the charts and price action, because the stock market seems to be realizing this lately. The chart looks like it woke up from a long nap.
It certainly is awake now. The stock has surged 230% over the past year.
We are looking at a market cap of, what, $6.86 billion? But what stands out to me is the momentum. It broke out from a 52-week low of $1.83.
Yeah, think about that. If you were savvy enough or lucky enough to buy in at the lows, you've more than tripled your money.
Right. And recently, it's been trading in a range between $5.94 and $7.29. Technicians would call this a consolidation or a flag. But generally, it's signaling higher highs. It's not just a spike and a drop. It's climbing the stairs.
And the volume tells the story, too. You can have price movement on thin air, but here we are seeing unusually high options volume.
Which usually means volatility, right?
It means interest. It means people are placing bets. Elevated interest from both retail investors and institutions. They're all placing bets on where this price is going next. We recently saw an 8.35% daily gain tied specifically to trial results.
That's a big move for a single day.
It is. It shows that despite what the sentiment algorithms might say, the actual money flow is reacting aggressively to good news. The momentum is undeniable.
Okay, you mentioned sentiment. Now let's look at how the market is feeling about this. Because when I look at the data, I see a disconnect. It's weird.
What do you see?
I see a quantitative sentiment score of 0. Neutral. Flatline.
That is fascinating, isn't it? You have a stock up 200%, revenue up 1,000%, but the sentiment score is a big fat 0.
It's because the news cycle is schizophrenic. On one hand, you have headlines like gaining market support and trial successes. On the other hand, you see Immunitybio on the top 10 most shorted lists and short squeeze targets. Have a total battleground stock.
That explains the neutral score. It just averages out the extreme bullishness and the extreme bearishness. It's like having one foot in a bucket of ice and one in a bucket of boiling water. On average, you're comfortable, but in reality, it's chaotic.
Right.
But if you look at the human analyst, the people actually writing the reports, it tells a very different story.
Yeah, the analyst consensus isn't neutral at all. It's a strong buy.
And look at the price targets. The average price target is $11.80.
With the stock trading around $6 or $7, that implies, what, almost 98% upside. That's practically a double your money call from the pros.
Exactly. You have H.C. Wainwright raising their target to $10 just recently in January 2026. BT raised their target to $9. The professionals who actually study the trials, who read the medical journals, they're saying this is worth double what it's trading at.
They're looking past the daily noise.
Yeah, they're looking at the fundamental value of the drug pipeline.
But here's the catch. Are the big institutions buying it? The composite score ranks them number, what, 1,295 out of 10,000? That's okay. It's solid, but it's not elite.
It's in the top 15%, which is respectable. But you're right, we haven't seen that massive cluster buying from insiders recently where 5 executives all buy at once. That's usually the strongest signal.
However, the stock is considered undercovered.
Which is an opportunity. If the big institutional funds, the pensions, the sovereign wealth funds, haven't fully piled in yet, but the analysts are screaming buy, that suggests there is untapped potential. When the big funds finally decide to move, that's when you get that next leg up. Retail has driven a lot of this. The institutions might be the second booster rocket.
Okay, but before we get too excited about the next leg up, we have to look down. It's time to look at the downside. Let's unpack the bear case, because there is a reason this is a battleground stock.
Absolutely.
You don't get shorted this heavily if everyone thinks you're a slam dunk.
You don't. And investing in biotech is not for the faint of heart.
First off, short interest. As of February 13, 2026, Immunitybio is on the top 10 most shorted list.
That is a double-edged sword.
It is. On one hand, you have that short squeeze potential. If the price jumps, the shorts have to cover, they have to buy the stock back, which drives the price up even further. It's the rocket fuel, the GameStop mechanic.
Right. But on the other hand, you have to ask, why are they shorting it? It means a significant portion of the market-sophisticated investors, hedge funds, are betting heavily that this company is going to fail or is just drastically overvalued.
They're putting real money on the line saying, this price is wrong.
Exactly. And if momentum fades or there's a piece of bad news, that drop could be steep. Those short sellers will pile on and the long investors might panic.
And let's talk about that valuation gap again. A $6.8 billion market cap, negative free cash flow, net margins of negative 420%.
It is not a value stock. You can't look at a PE ratio here.
Right.
No, you are paying for future growth, not current profits. You are paying for what Immunitybio could be in 2028, not what it is today. And that brings in volatility. The beta is 1.5.
Meaning it's 50% more volatile than the market. If the S&P drops 1%, Immunitybio might drop 1.5%, or likely much more on a bad day.
The biggest risk for me, though, isn't the chart. It's execution risk. When you have a valuation that prices in this much success, you are priced for perfection.
Priced for perfection. That's the scary phrase.
It is. It means if there is a delay in a trial or a regulatory hiccup with the FDA, or if manufacturing hits a snag, the stock price gets crushed. The market is assuming everything goes right. The margin for error is razor thin.
That's the nature of biotech investing, isn't it? You're betting on the science and the regulatory approval. If either of those falters, the whole model just collapses overnight.
Precisely. It's binary. It works and you win big, or it fails and you lose big.
So we have a company with exploding revenue but is burning cash. A stock that's tripled but is heavily shorted. We have analysts saying buy and algorithms saying neutral. So where do we land? Let's give the final verdict.
Okay. I am giving Immunitybio a bullish score of 8 out of 10.
8 out of 10. That is pretty high, given the cash burn and the short interest.
It is high, but you have to look at the trajectory. You simply cannot ignore 1,026% revenue growth combined with 99% gross margins. That is a recipe for a cash-generating machine once they scale past their fixed costs. The economics of the business model are beautiful if they can scale.
So you believe the product is the real deal?
I do. ANKTIVA is proving to be a legitimate disruptor. This isn't just another slightly better chemo drug. It's chemo-free immunotherapy. That is the holy grail of cancer treatment effective without the devastating toxicity.
And if they capture even a fraction of that market.
The current valuation is cheap.
And what about the valuation numbers? How do you justify the price tag?
If you look at a discounted cash flow model, a multi-year hold unlocks a valuation of $20 plus.
It's $20. That's triple the current price.
It is, but it's all contingent on the pipeline. It depends on trials like Rescue 215B, which just launched phase 2 in February, continuing to de-risk the commercialization. If that trial data comes in strong, the risk premium drops and the value unlocks.
So what should we be watching right now? If I'm holding this stock or thinking about buying, what's the next big event?
Mark your calendar for March 2, 2026. That is the earnings date.
It's coming up fast.
It is, and the consensus is looking for confirmation of the full 2025 revenue ramp. They need to show that the growth wasn't a fluke. If they beat earnings again or even just confirm the trajectory, that could be the catalyst that squeezes the shorts.
Any other rumors or whispers in the wind?
There is some speculative chatter about Middle East expansion. We mentioned the Saudi FDA approval, but there are rumors of deeper partnerships via biopharma Sagala. If they announce a major distribution deal in that region, that opens up a whole new revenue stream that isn't fully priced in yet.
So, final outlook.
For me, it's a strong buy hold, but for a multi-year horizon. You have to be willing to stomach the volatility. You have to be okay with the swings. But I think riding the momentum into the March earnings is a smart play.
It definitely feels like a high-stakes game, but the rewards, both financial and for patients, could be massive. It's rare to see a company with this kind of growth profile that's also attacking such a difficult problem in a novel way.
Exactly. And that's why, despite the risks, the bullish case is so compelling. It's not just about the stock going up. It's about a fundamental shift in how we treat disease, and the market is finally waking up to it.
Well, we will certainly be watching that March 2nd date closely. If you found this analysis helpful, make sure to subscribe, like, and comment to this video to support the show. We want to know, are you buying the dip or are the short sellers right? Let us know in the comments.
Thanks for listening, everyone.
See you on the next deep dive.